Trump's back in the White House. What does that mean for multifamily economy and housing specifically? We're going to talk about that today on the Gray Report, in addition to what's going on with the LA fires and how does that affect real estate, insurance, risk, free markets. We're going to get into that a little bit. Of course, housing broadly and multifamily specifically, getting in reports from NAR, RealPage, BizNow, CNBC, Wall Street Journal, NBC News. You're not going to want to miss a minute of the Gray Report. So strap in, grab yourself a cold beverage. We're in for a great show. Make sure you like and subscribe to the Gray Capital YouTube channel. Let's get into it. Welcome back to the Gray Report, joined again by producer and director of communications and marketing here at Gray Capital, Dr. Matt Bossnagel. How are we doing?
Hello. I'm doing pretty great, actually.
That's good.
A lot of
You're recovering from a long MLK weekend?
Yeah, it was. I got a whole lot of sleep, an
yeah?
obscene amount of sleep. It was pretty nice. I don't know how people are feeling
That
after
sounds nice.
after the big thing happened yesterday. It was a big
something happen?
college championship game.
Oh, that's
And
what
maybe
happened yesterday.
it was a big transition for some people from one thing to another, and a lot of Ohio State fans are happy. And then on the other side, there's another half of the country, Notre Dame fans, that are not so happy.
Yeah.
So it seems like that's what's happening right now. That's what I'm thinking. That's how I'm interpreting it, at least.
That's it. Well, other news and change. Obviously, we've got a new presidential administration that just took the seat yesterday, and everyone is kind of on the edge of their seat. What what could happen next? Obviously, a slurry of executive orders were signed yesterday.
I've been heard it called a flurry, but I like a slurry better.
Yeah, I like slurry. But it's like
Yeah.
it's a large vat of things that are being mixed together.
Yeah. I love it.
So we're going to talk about that. Some of what we might be expecting. It's how it all intersects with the housing and the multifamily market. Because on one hand, just tariffs, for an example, is that going to have an effect of increased the cost of building materials, steel, lumber? I mean, we saw some of those effects, but also it was combined with the pandemic back in 2020. But at the same time, some of those tariffs might spur more manufacturing and reshoring or onshoring and manufacturing, making stuff in the United States, which would be a good thing. So what is the net result? And it's hard to quantify, not knowing all of the details, although some tariffs were announced pending for Canada in February, it sounds like.
Yeah, we'll see how that goes. I think we also this week have got a really good status of what the housing market looks like and a rundown of really the economy as it was kind of in November and December and now. We've been in a little bit of it. People may have said it's shaky and certain, but it hasn't changed too much in terms of either sentiment or 10-year Treasury rates.
Yeah.
So I think that the upshot to all that though is it's not too bad. We're not heading either way. It's relatively stable and not a whole lot to worry about at the moment. So
yeah.
Inflection point indeed.
Just get ready for a little bit of volatility here or there. Well, let's jump into housing broadly,
right. Yes.
as you labeled it, Matt. There's a new report from the National Association of Realtors, Residential Real Estate Snapshot, November 2025, which you correctly mentioned is some of the more recent data that we have. We don't usually get the data right away next month on a couple things that we do. So get us up to speed, Matt, on this report.
Yeah.
It covers the entire housing market and the economy.
So just before getting to home sales specifically, NAR touches on some housing demand drivers like GDP, steady around 3.1. That's pretty good. I think 3.2 is like the historical average or something around that. So 3.1 is pretty dang good. Federal funds rate 4.8% could be a little better, but the plan is that it keeps going down. Inflation 2.7%, not too bad. Consumer spending also not bad. They have a graph of consumer spending here. I think it's easier to look at the year over year. And if you do look at the year over year, you'll see that consumer spending is leveled off at just a little higher than it was pre-pandemic. Now, this is the PCE number, and that's, I guess, what the Fed uses. But again, it's not too bad either. I'll add a bonus here. So we're looking at the 10-year Treasury yield, which is actually, this is the most frustrating graph here. I think, with 10-year Treasury yields high and higher than the 4.36 number that it cites, for November. It's much higher than that right now. But
Well, and it's interesting. His prediction shows that this was done, even though this is recent, how it's really out of date. However,
Yeah.
additional rate cuts to follow from the Federal Reserve. This is quoting from the
Oh, wow.
piece. NAR predicts that the yield will decrease to stay below 4% in the new year. Well, that narrative has certainly changed since
Yeah.
the writing of this, because now I think the base case is the 10 years going to be like in a range between, maybe, 4 to maybe to up to 4.75.
Yeah, that's a
in
really
much
good point.
higher range. Now, this also I think highlights how quickly the narrative can change. Because, for example, if we get some like very weak CPI prints, if we get if unemployment starts going the other way, we could start to see the 10-year start to fall really pretty quickly. It's just I think we don't have the data to show us. But on the same vein, we could have the data that keeps the 10-year Treasury elevated, and especially we were just talking about whether it's tariffs or volatility. That doesn't typically we're not going to necessarily see rates come down if we see that kind of volatility and uncertainty with inflation.
So it is that Treasury yield that's a little shaky, a little more uncertain, a little potentially worrying, just frustrating, I guess. And then I did add a bonus, which is credit card debt. And that's not here. I just researched it a little, and it is leveling off to about the same level of growth, which is 4.9%, as we saw in the months before the pandemic. So things do seem to be approaching. There really are like flattening. All these graphs that I was looking at last night, flattening out to what is maybe slightly higher activity than pre-pandemic, but awful close. And the fact that it's approaching that and that it's flat suggests a little more stability and consistency than people maybe were assuming. We're either heading towards salvation or doom, but no, I think it's just normal life.
Exactly. It's just normal struggles.
Yeah.
And there's never rarely do we get to a point in the economic cycle where it's like, it's all good. We're fine.
Yeah,
We're good.
yeah.
There's always a worry card. When it's really good, it's too good. What's right around the corner?
Oh, yeah. Agreed. And I'm glad you have this employment map up here because it does show employment nationally at the state levels doing fine. I think Wisconsin and Michigan stand out with low unemployment in the Midwest, but it's also not hard to notice the low unemployment in the South and this kind of like this belt across several sunny states. Fairly low employment on that.
Yeah, all in the threes. Really nice.
Yeah. So things are not getting worse. Like I said before, I think they're getting better slowly, and it's been a while that this trend has been in place. I'll feel a little more comfortable about the long-term strength of the labor market, but even that's not too bad. We had strong jobs numbers. It's always a balance when it comes to labor market and inflation.
Say Louisiana has a 0%.
It does look like the
employment change. Sorry, the unemployment rate is 4.3%. Okay, that makes much more sense.
So, as for home sales specifically, sales have been slow for over 2 years, pretty much across the board. And currently, home sales are stalled with 7% mortgages.
Well, there's no inventory. I mean, it's hard to buy a house, and there's very little inventory.
Yeah. This is a really revealing chart. So, in the NAR article, they have existing home sales. This is new home sales. Everyone said that, people are stopping. The lock-in effect is what they said. They said people are staying in their existing homes. The existing homes are not for sale. The ones that are really being bought hand over fist are new home sales. But you can see at this graph, that's not really the case. People are buying as many new homes now as they were a little bit before pre-pandemic. In the same spike in new home sales that occurred a little bit after 2020 when rates were really low, that same spike happened in existing home sales as well. So it doesn't seem like there is a trade between existing and new home sales. It just seems like there are less home sales because of high interest rates. Now, I say less but that's like a relative thing. I think that there certainly are less existing home sales, but relative to demand, you would assume that given the progression pre-pandemic that we'd have more new home sales now. It's just, I think, debt is the increased cost of mortgage payments are really hurting home sales.
For as normal of a graph as this looks, you can make the argument saying the housing market seems pretty like healthy and normal, but it really doesn't feel normal at all because the situation of who can afford the mortgage to live in a home, to acquire it, the affordability aspect seems so abnormal, but everything else, it's still finding this interesting equilibrium between what's on the market and there's enough buyers there. And I would, this is interesting because it's not just, it's easy to believe that prices are about the same. They've increased a little bit year over year. Certainly haven't fallen off a cliff.
Yeah.
I think the common assumption is that's on just low volume, and the reason that we're just seeing a lot fewer homes sold, and so there's less buyers on the market, but the number of buyers and homes for sale are lining up, and so pricing is is favorable. But this is basically saying that no, these new home builders, they're cranking out homes, and people are still buying them at the same rate as they did in at the higher rate as 2018.
That's the new homes, and the new homes. These numbers are 600, 700,000.
And builders are giving concessions, and there are a lot more. And I would say there have been, if we could overlay this chart with new single-family home development also.
So if you go back into the NAR article, now they may be pulling on different data sources, but when it comes to existing homes are about 5 times typically the amount of new home sales, and the existing home sales really have fallen off a cliff.
And is that because on the new homes, builders are providing incentives, mortgage incentives, they're giving discounted rates?
That could be. I think just as likely is you got to kick someone out of their mortgage to get an existing home. You may not have to do that if it's a new home.
Good point. Those are just the homes that are available. Is what you're saying, and that's when I occasionally will look on the housing market, and I'm pretty much looking at existing homes. There's not a whole lot of options, but if you are looking to buy in a newer neighborhood, a new house, there are definitely builders who have homes available.
Yeah.
It makes sense.
But the surprise that I had, and as much as we said that new homes are relatively healthy, I think new homes took a hit because of high rates. I think existing homes took a hit because of high rates. So it's this both really happened, and I think both you could even say that it's even worse because I think that demand has gone up. Population has grown a little bit. Housing demand has gone up a little bit. There are these pressures. There's a pent-up demand. I think it's being held back by mortgage rates, and that could really stand to be released. I think that supposedly, so for existing homes, the census numbers are 3.76 million in sales. NAR has the number at 4.15, but either way, you get 5 times as many existing for new homes. I think I already said that, but still, it's an interesting moment that we're at in the housing market where there still is a lot of demand. There isn't any compelling story of home price loss or home value loss. It's this would have been an interesting article. I can see if I can look it up real quick, but I think there was just a report from it was like a Wall Street report that essentially said that the analysis is that single-family homes in the United States are overvalued anywhere between 10 and 20%, and those prices should come down. Now you can say that all you want, but unless those transactions have to happen. All right, man. I was able to find this article from the Wall Street Journal. Wall Street thinks U.S. homes are overpriced. Then subtext: housing could be overvalued by anywhere from 10 to 35% based on how investors are acting. I think that, one other explanation is home buyers are willing to pay more than investors. And we've seen that time and again where the Wall Street will buy as cheap as they can. They don't have an emotional stake in it, so they're not going to buy with their heart, and oftentimes the heart will make you pay a little bit more.
100%. Yeah.
And I also think that part of the American dream papers over a lot of repair costs and just the burden. But if you look at it through your Excel spreadsheets, then you realize, oh man, this is that's going to cost a water heater, the knob and tube wiring. You got to do that. So there, because a home buyer isn't making this transaction hundreds of times or tens of times every year. This is once, twice, 3 times a lifetime where they're thinking about this. So that's a part of the housing market that people don't really think about as much. I know that there are real estate agents that will guide you through this process, but mentally, that's got to be a big effect, a big difference between the investor buyer and the home buyer.
Yeah. Hey, Nat, so I'm reading this piece on the Wall Street Journal, and there's a comment that I would like for you to comment on, if you don't, if you would entertain me.
Yeah.
Jim G. The spread in valuations explain why owner's equivalent rent, owner's equivalent rent, or OER, is used to compute housing costs in the CPI inflation calculation rather than comparable sales data. Owners are asked how much their home would rent for rather than the government simply looking at house prices. Owners don't think in terms of cap rates, so lowball their rent estimates. The result is that housing prices are underestimated in CPI by about 30%, similar to the discount on stock prices referenced in this article.
I don't really disagree. I think that's a pretty solid take on that. And it is revealing too that like, oh, so they're determining home prices based on just people asking. That's one thing you never do. I don't rent out my home every other month, so I don't know. I don't know. How would I know? Yeah, and I wonder if CPI is like, hey, by the way, this is how you calculate it. Are they just asking?
Who are they surveying?
Yeah.
Who? I know I've read about it, and apparently they mix it up, and it baffles the mind.
You don't want to tell people how to, because you want to give them that freedom to give their own answers, but also you want to tell them, I would tell them a little bit about cap rates and just be like, well, this is prevailing cap rates.
Yeah.
I don't know. I guess it get too complicated. Yeah.
Yeah, that's okay. All right, so moving on from that, but staying on the NAR piece, looking at new listings, inventory. Looks like new listings are down a little bit, 1.8% a year over year. That's kind of nominal. That's kind of, again, sort of we've been talking about. Inventory has been declining overall, but there's been certainly like a push in the last year. Basically, since throughout 2024, we saw an increase in inventory, kind of bring us back to 2020. I don't know if this is just delivery of single-family homes, of new homes, I guess would be.
It's really interesting to see, even pre-pandemic, the inventory, for sale inventory has these phases that almost last like a year, or they come up in the summer and then they go down in the winter and then they come up in the summer. So that the latest data that we have here is for August. So that really does align with, we could see a dip in inventory. Inventory could be lower than it is in this graph too.
Yeah.
Even so, but the more compelling trend is every year it seemed to, from 2016 until 2022, it seemed to go down, and now we're just almost a little bit up, but still not quite. So we've got a ways to go.
Well, and it makes up, because if you think of these housing starts kind of peaked in 2020, end of 2021, 2022, which makes sense because interest rates were still zero. This is kind of peak ZERP, and it takes a minute for some of those houses to be built. And so then we had a little bit of a surge back up here in 2023, I guess the way.
And it makes so, and this is a little bit reassuring that like the market forces that are acting on the multifamily market and really making it hard to build are in a small part, at least, acting on the single family market. It's not like they were completely ignoring the high rates that were making it hard for apartment builders to build. So home builders, no matter what, they're not building as much as they would probably like to. I think that this is a case, whether you're building or whether you're trying to sell or buy, there's a lot more demand than there is capability for supply. It's sad.
Very true.
Numbers are low in the wrong places, and that is probably why the housing, the price of home prices have just kept up amid the high rates.
Yeah. Well, in terms of new residential construction, a lot being built in Connecticut, DC, 4,400 units. I mean, that's more than many other. That's more than New York at just under 2,000. Hawaii, 1,300. That's a lot. California, again, one of the most populous states, 650, which I think more is about, shows how less just construction is going on in California, I guess.
Yeah.
Also, Texas is interesting. Not that much.
So this is they're taking the
population per single family building permit by state. So I guess the size of the population has a
So for
negative effect on the number.
So for every 186 permits, every 186 people?
The ratio is calculated by dividing the number of a state's population by the number of single-family building permits issued in the state within 1 year.
That means that perhaps there's a lot of single-family permits in Texas.
Yeah.
Wow. Okay. A lot of building.
This is
and it makes sense that
this is a weird. I don't love.
I know it's not immediately, but it is interesting.
I understand what's relative.
So then, if you looked at New York, you know why there's like 2,000 per building permit because they're not building a whole lot of homes there. But I think it's reversed, and I think it's messy.
Yeah, I don't love that. Okay, new residential construction. State year-over-year percentages changes of single-family building permits as of November 2024. Pretty much everybody's down. Again, we've seen this in multifamily building permits are way down, starts are down. Only a handful of states where they're positive. Ohio being one of those. Looks like they made an error here. And
they didn't even include Indiana. They mentioned Illinois twice.
They just mentioned Illinois twice. Thanks. That's what it's like living in the Midwest.
Yeah.
Anyway,
they fly right over you, no matter if they're in a plane or not.
But it's interesting, states like Wyoming still seeing growth, really in the Mountain West. The Dakotas still very positive. Minnesota, Wisconsin, Idaho, Montana. But then most other states are pretty negative. I guess what do we got here? Just Delaware. We got Maine and
Connecticut. District of Columbia down 88.9% in terms of their building permits. Wow.
But then Alaska and Hawaii. Alaska has 66% year-over-year change in building permits, and Hawaii 50%. Interesting.
Yeah.
Okay, well, this is a really good piece, Matt.
So
anything else on just general housing broadly?
Yeah, if we are going to talk about, this is what I really wanted to get out of this is this state of the economy that we're in. We're still in a state where low supply, high demand in housing, whether you look at single family or multifamily. And the driver of this is still interest rates. And so that is something that I think probably the incoming administration is going to be sensitive about. And it is something that was mentioned in some of his speeches and stuff last night was about housing, and it is a concern. And I was reading some of the stuff on Trump's nominees. Like, they're not ignoring the housing crisis at all. They're not. They have their own solutions for it. So we'll have to see how that works and how that dovetails with inflation and interest rates. And
it will be interesting to see how the Trump administration tries to influence monetary policy at the Federal Reserve, or what they try to do on the fiscal side or at Treasury in like issuing bonds in order to effectively lower interest rates. The president's authority is, the Federal Reserve is technically a private organization. The president nominates the chairman of the FOMC, chairman of the Federal Reserve, but it's a private organization, so it's not like Trump can go in there and tell them where the FOMC where rates should be.
And there's like market forces for. But you're saying that
that's where they could have some impact is on the fiscal side.
Very interesting.
And so, if for example, if they were able to get the deficit under control, that should reduce the 10-year Treasury.
Okay.
Now they also have, but if they spend a lot, which they want to spend a lot, that could increase the deficit. That could have upward pressure on the 10-year Treasury. They could change the way they're issuing bonds, and one big challenge right now is they just have all of this shorter term bonds that are coming due. Because they wrote a lot of just short term paper rather than having longer maturities. That needs to be converted to longer term maturities at some point, getting off like the 6-year and like the 2-year notes, pushing it some out to the 10 and the 20 or the 30. But the problem is the short-term rates are all, so low, then now we're borrowing at a much higher cost. And so if you can find a way to be able to get those rates down, we'll be able to reduce overall debt service of the United States would be very beneficial. But there's a balancing act because on one way, if they try to make progress on a variety of initiatives that cost money, including tax cuts, that can increase inflation or increase interest rates. And then the opposite is true. I mean, if they stop spending, they won't be able to achieve some of their goals.
Yeah.
But they might be able to get rates down. So I think that really,
there is no contradiction in their aims nor in their methods that they use to accomplish them. I have complete trust in this incoming administration.
As no politician has before.
Yeah, that's right.
Okay, I want to talk about this real page because the man Carl Whitaker put out another really interesting piece that kind of he's got a really good pulse on what's going on in the multifamily market, and I don't know. I think he's been hinting at something that you don't want to miss. The market in 2025. And so this is a piece on apartment rent growth expectations at the market level for 2025. So we're getting away from national rent growth, which it's an interesting metric. I think, again, it can summarize generally how like the business is doing, but every market and submarket is so different. I mean, we're looking at this deal right now that, and literally, across the river, it's a completely different market. Yeah. And the rent growth is different. The jobs are slightly different. Just different demographic dynamics, and so you have to be specific.
Well, and that's one of the things that I remember talking about a few weeks ago was 2025 may be a period in which the divergence among markets increases before it comes back together. Yeah. They may snap back in 2026 when supply becomes in a greater balance, but there's still some runway in terms of like how far apart these are, the ones with huge supply and the ones with very little.
I really like this, the way he's got it. 2025 performance expectations based on market profiles, and then a little color-coded system. I don't like about it is I'm kind of colorblind, so it's hard to see. But a lot of the fuchsia would be. Is that number one? Is that pink? Fuchsia?
No, but fuchsia pink? Is number 6 actually.
Okay, so how about Matt? How about you take us through the color guide?
All right, so we got the first group, and actually I have.
Is that pink? Is that gray? What is number one?
No, that is actually a bluish tealish kind of green. I know we've got a red green situation here. I actually think that other than the color code, if you scroll down,
difference in the colors.
If you scroll down to their naming, it's actually a little bit more. I think it's pretty interesting how he comes up with this grouping here. So there is minimal to modest supply pressure and stable demand. And that's where I was like, Midwest, anyone? And we'll have the markets listed here. Gateway adjacent. Second is gateway adjacent markets where occupancy supports historically normal rent growth. Places like San Francisco and Seattle. I think those are perfect examples. Markets with the third one, markets with little supply, but demand headwinds curb rent growth. I think there's a little bit of Rust Belt in here, a little bit of Midwest.
Cleveland, St. Louis.
Totally. And then there is Sunbelt markets that are at or even slightly past peak supply, which is like
Orlando,
Miami. Miami, Tampa, Dallas, Houston. These markets that have and will power through supply, the ones that like we never really counted out during the pandemic at all, and they just powered through everything. They'll recover probably the quickest. On the other hand, you have markets where weaker than expected demand has challenged fundamentals, which is it's a little bit all over. It's like LA, Minneapolis, Portland. It's hard for me to get a real trend on the larger, for me to get a read on these trends of these markets. Minneapolis, I think they had put some efforts into expanding housing supply, maybe even before the pandemic. I don't have a source for that, but like I know that was a initiative that they had, that this was like they wanted to get housing prices under control. LA seems like its own animal, and just because of how big it is, even discounting the fires that have recently happened.
So they have to redo it.
And then I don't know. I always grouped Portland with other Pacific Northwest markets like San Francisco and Seattle. But I'm not saying that this is wrong. What I am saying is like I've got to go to CoStar and my data sources and look up the supply story for all of these, because I'm sure they're super interesting, and it's something that we even talked about on the Gray Report, especially like Seattle, where before the pandemic I think they built a whole lot, and then they built so much that rent growth during the pandemic wasn't even that strong. Never really was as strong. Same thing. Well, for a different reason, rent growth was not so strong in San Francisco ever, because it was already so high. And then finally, It's these markets where supply pressure carries into 2025, potentially into 2026. Here's where you get your Phoenixes, your Charlottes, your Austins, your Raleigh Durhams. These are the markets that Jay Parsons doesn't want you to use as examples of the Sun Belt, but they are all in the Sun Belt.
They actually make the little smile right there.
That's
You
right.
just draw.
It's kind of belt along
you just
the
connect
sunny
the dots.
states. Yeah. They are not the one-to-one example of all Sunbelt states. Like there are some real juggernauts in the Sunbelt that will continue, and we just saw how the employment and population figures of these Sunbelt states are roaring. But there are places that just have built so much, it's just gonna be harder to dig out of them.
Yeah. And so just specifically, I mean, the markets with minimal to modest supply pressure and stable demand: Chicago, Cincinnati, Indianapolis, Kansas City, Pittsburgh, Richmond, and Virginia Beach.
Yeah.
These are all solid markets.
Slow and steady. What I think that slow and steady doesn't capture, though, is the fact that when there is an elevation, when there is like huge activity, whether it's rent growth or building, these slow and steady markets, they'll pick up things. They're not perfectly slow and steady. They're just a little less active, a little bit less volatile than the other markets. And if anything, it was to the upside probably, where some of the markets, they're seeing lower rent growth, and now we're just slow and steady. But it's more predictable. I think that's helpful from an investment standpoint. However, maybe you want more risk.
Yeah. Yeah.
But not me. Not right now.
Yeah. Yeah. Not. Yeah. I again, our whole thesis is largely based on a lot of this, and this is why we've been investing in Indianapolis and in similar Midwestern.
Because I was remembering the Berkadia research from Nate Stone and Jonathan Rappa, again the golden age of Berkadia research. They were talking about like, what was it, beta, the how like different kind of volatility in Phoenix could be to the upside, but like at any given moment it could slip down, but over time you'll be on the upside.
Yeah,
you just have
low beta markets.
But there are real swings that you're gonna have to deal with in the meantime. So I don't like the idea of timing that, and like we don't know enough as much about those markets specifically, but like it does seem like timing is such a huge thing. You have to have the power and the money and the resources to either get out quickly or to wait it out.
Well, that's a really good description. I mean, the key to success in those volatile markets is it can be timing, because if you join the party at the wrong time at the end, and you have a shorter term business plan, because you're trying to capture all that growth and move on to the next one, it kind of goes hand in hand with a more aggressive strategy. Yeah.
And if you live there and the developers, and you kind of have been keeping an eye on how things are going and then it could be really great for you, but not, from an outsider's perspective, it's a little more difficult.
Well, and it's frustrating because you could have picked the right market, right submarket. It just, the timing might have been off a little bit.
Yeah.
And there was demand, but then all of a sudden everyone had the same idea that you had at around the same time, and then not just what your apartment was delivered, 200 units. You've got thousands of units in the same submarket that are all competing at the same time that you didn't have a great job of anticipating. And so, over time, it'll all work out, but you're on a 2-year bridge loan. So you don't have time. So give yourself time and go into a market where those time squeezes just don't present themselves as often, and you can just let the asset grow and make really good returns over time. So, gateway, we don't have to list all these, but, under second category, gateway adjacent markets, that'd be like Boston, Inland Empire, Newark, New Jersey, Orange County near Anaheim, San Francisco, Seattle, and Washington, D.C. The markets with little supply but demand headwinds curb rent growth: Baltimore, Cleveland, Greensboro, Winston-Salem, Memphis, Milwaukee, Philadelphia, Sacramento, and St. Louis. And then Sunbelt markets at or even slightly past peak supply would be like a Dallas, a Houston, a Vegas, Orlando, Salt Lake City, South Florida, Tampa. It's interesting. I feel like the collection, these are interesting groupings, and because like I'm just thinking of different like sponsors and investors I know, and like literally like sometimes it seems like it can be like an eclectic mix of markets, but I'm like, I know an investor that does like those are the markets that they invest in.
Yeah.
Similar to like at the top of, I'm like, these all look familiar. These are all markets that like I am invested in or considered or considering. Like Virginia Beach, I've always liked the Virginia Beach market. It's a little bit out of our like geographic expertise. Kansas City, always really like. It's similar to Indianapolis, which is our headquarters. Pittsburgh, it might as well be a Midwestern city. You know, it's Western PA.
Yep.
And Richmond, I'm not as familiar with, but like I'm like this list. I'm like, yeah, I could get down with that list.
Yeah.
But then I go to this. I'm like, these are like institutions that I don't know. Like I've talked. I know people who focus on these markets, but I'm like, it's just a different food group.
Yeah.
To me, it's just I don't know how to operate in those markets. Boston's there's just huge firms, a lot of more institutional capital.
Interesting.
Foreign investments.
That's interesting how these are lining up from your perspective as from the acquisitions perspective and the players and how it lines up with the performance. Yeah, for sure.
Because it's like I'll talk to someone and you think that. You know, you talk to a ton of investors in the Sun Belt, and that makes sense. But then you start having conversations with these guys who are like, we only invest in like the gateway markets, like the LAs, the Bostons, the New Yorks. Like, oh, okay, that's totally different from what we do.
Yeah.
But it's not. But the markets just seem they have a different profile.
Yeah.
And it's hard to like readjust again, even though it's the same thing. Like the process of buying and operating the multifamily property. Obviously, the rules and regulations can be very different.
Yeah.
But it's like I would really never consider doing a deal in Boston or I mean, New York's a whole other story. But again, like I'm reading this list, I'm like, I wouldn't do any of these.
Yeah.
Not that there's not a lot of money made and there's experts that do them. It's just not for me. And this list, like none of these markets. Okay, the two of number 3 markets with little supply but demand headwinds curb rent growth. Yeah, these are all like. A lot of these are, rustier markets that some I've been like curious about, but I've never been convinced that we needed to press go. The closest I've gotten is St. Louis because there are some submarkets in suburbs outside of St. Louis that are really strong.
Yeah.
But like it has to be all real estate. You have to be very granular. Some markets more than others. Memphis, I've done a deal in Memphis. Didn't have a great experience. I'm just not hot for the market. I'm sure there's a Memphis expert that can just crush it there. Greensboro, same thing. These are all markets that like I have considered and either I've like said no to or just probably not. Like Cleveland, like there are some suburbs in Cleveland I think that could make sense if you know what you're doing, really location specific. But it's just negative population growth.
Yep.
It's just there's not a lot for me to get excited. Baltimore, same thing. Milwaukee, kind of, sort of. I like the idea of Milwaukee more than a lot of the others.
Yeah,
to be honest.
Nice. It's a nice city.
Now and then again, this is really where I had this realization because I'm like, oh yeah, I know like 24 sponsors that this is their list of property, or like pick, like this is your typical stereotypical syndicator markets.
Yeah.
Because everyone's like Sunbelt. Let's go to the Sunbelt. And Dallas, I mean, how many people we know focus on Dallas? Or again, a combination of like 2 to 3 of these markets.
Yeah.
Houston, Vegas, Orlando. These are all markets that like 5 years ago all were projected to be the top rent growth markets. And this is where all the demand. And it's also where the supply ended up all coming, which has brought down rent growth considerably.
Yeah.
This is like similar. The 5 markets where weaker than expected demand has challenged fundamentals. These are just like, I don't know a better way to say it, Matt, but like just like liberal cities, like really strongly Democrat, like Atlanta, LA, Minneapolis, Oakland, Portland, and San Diego.
Yeah, I think that is true. There is that political coincidence.
Does that have nothing to do with it, or do I just make? Well,
I think in terms of like the rent growth
these have
stories,
in common?
They were never. Atlanta was doing pretty well with rent growth, if I remember.
Yeah.
But for all of these, they were never really top of the charts. They never had like a time where they
Atlanta's
shined.
a little bit of an outlier.
Yeah,
except
I would group.
I think
Atlanta
Fulton
closer.
County's pretty blue.
Yeah. I think that LA is also its own animal because of just how big it is and frankly,
these are all
like
markets that have been kind of mismanaged due to local governance.
And Minneapolis, we were talking about Minneapolis and their kind of choking regulation in the name of housing affordability.
It's like just crime.
But no, but Minneapolis had we talked about like their eviction policies but I thought
none of these markets you can evict somebody in.
You cannot.
You cannot. It's harder. It's very difficult to evict someone in all these markets. And there's weaker demand. Weaker than expected demand is challenged fundamentals.
But it could also mean if they're kind of ranking these by performance, maybe cheaper housing in these places. So
good luck. But that's the thing. There's not cheaper housing. Yeah. I mean, maybe some parts of Atlanta, but L.A., Minneapolis, there's probably some affordable spots. Oakland, not really. Portland, not really. San Diego, not really.
Because demand, it's saying weaker than expected demand has challenged fundamentals. It is saying like, well, there's something about it that is not really.
Because everyone's leaving these places.
Could be.
I don't know. Maybe not Atlanta. Not everyone's leaving Atlanta. And then, I'm sorry, we're spending more time on this, but I'm just trying to. I'm playing a game of just what do these all have in common.
Yeah.
And here's another list. I know half a dozen sponsors that this is like their target markets. It's the correlation for the type of market, and it makes sense. But sponsors, you're going after markets with. You have a certain strategy in certain markets, meet that strategy more or less, or the kind of the KPIs, the metrics, the size, the growth rates.
Yep.
They line up, but Austin, Charlotte, Phoenix, Raleigh, Durham, and San Antonio. These were other high-flying, well-advertised markets to invest in by syndicators in the general multifamily market, and all have incredible long-term growth prospects. But as we have just mentioned, there's too much supply.
Are these red state markets outside of maybe Phoenix? I'm not sure.
Austin, it's red state, but I mean, all
blue city probably.
All blue cities. But
what cities not?
They at least have things going on.
Yeah.
Okay. That was the real page piece. That was awesome. Yeah. All right, where are we going to?
And just
next?
To put a bow on this real page piece, it's nice. It's nice to have this.
I was told by an attorney today they wouldn't put a bow on it.
Oh. Well, I love bows.
He's like, you guys want a bow on this thing, and we're not going to deliver you a bow.
Well.
He's like, it's not going to have a bow on it. It's going to be good, but it's not going to be wrapped in a bow. I'm like, can it be wrapped? Can you wrap it?
Yeah.
It's like when you're checking out around Christmas time at the mall, and they're like, do you want us to gift wrap this? It's like, that's an option.
Yeah. And then they follow up, well, it's not going to have a bow on it.
Yeah, and they're like, don't just give me a box. Like,
that's really funny.
Or that's like, fine, really I'll take a box, I'll find the bow. That's how we set up the agreement.
We can give you a sticker bow, metaphorical sticker bow, obviously, and legally. But yeah, I think that I like this Carl Whitaker article because it showcases the diverging markets, and there are groups, and they're all are taking different paths, and maybe that's going to continue. That's what I would argue in 2025. So
on your notes, I'm not saying that we delete this. I'm just noticing things, and I can share with the audience. This is some of the things that I have to deal with. So you progressively made the font smaller?
Oh yeah. Because I said that when I was going, I was like, these are all like the Phoenix, Charlottes, and Austins. They're markets that Jay Parsons doesn't want to talk about, but they're all in the Sun Belt.
I see.
That was my direction.
So it's like a timing.
Yeah.
I'm reading. So Matt prints out notes. For
I'll
what
put
we're
a
going to be talking
screenshot
about
here.
and kind of what he's going to talk about and what we're going to talk about. And okay, you'll put a screenshot.
Yeah.
And I'm just going through, and
it's nice. Well,
it's fascinating.
Some stage direction there. That's what it was.
I love it. Okay, Trump's back.
Yeah.
The adults are back in charge. Whatever you want to say. Farewell to the Biden administration. Farewell to DEI, wokeness, and all of that. Or so it may seem.
Yep.
Are we living in a different world now that, again, Trump's back in charge? Everyone seems to be optimistic. And if take the politics out of it, everyone wants the United States to be successful.
Yeah.
Everyone wants the president of any party to be successful. And I can't remember, it's probably been since the election of Barack Obama that people were so, I guess, excited for what is to come. And we're not sure what's going to happen. But this idea of like the golden era of the United States of America and reverting back to, like manifest destiny and like, instead of writing the last chapter of the United States of America, like what is, this is just like
we've been at the intermission, and we're going to write the second half of the saga, or the next book in the saga. Mm-hmm. Man, if you've never been disappointed by a politician, just get ready. Not that I'm hopeful. I hope a lot of really great things happen. I think there's going to be some really incredible things, and there's going to be some not great, maybe even horrible things. The risk of staying out of wars, like, hey, let's get out of a lot of these wars, but there's also a risk that we might actually start a war. Yeah. So all of the same pros and cons of Trump, and generally the country has decided, as no other country in the world will do this, because no other country is willing to take the risks that Americans are willing to take. By making the calculation, which I believe Americans did, that like, look, this guy isn't perfect, but we're going to roll the dice because whatever we've been doing hasn't worked, and there's enough things that we'd like to see happen, which that list is different from depending on who you ask. Yep. If we do some of these good things, and if we don't do the bad things that we don't actually think you're going to do, this has a chance of working out, and we will at least, like, again, it's like pressing the reset button. It's like, taking the boggle set and shaking it up again. Like, let's see where all the pieces land.
I also think that the majority of Americans had an implicit trust in the resilience of the institutions that Trump has claimed to destroy. I don't think that that voters really think that everything is going to flip-flop completely. They know that, the trains are still going to run in time,
Generally,
not just as well as they did in the past.
We'll be going on trains. We're going to be taking
that's
rocket
right.
ship. We're going to be taking Starship.
Yeah, exactly. That's right. But like I said, like I think that there's an assumption that things are going things will last, right? Whether it's rule of law or whatever, or just like the standards and stuff like that. I think that one thing that has been striking though in even just this past 2 days is the amount of signals that we have that things are going to be different. Whether we're calling large land masses the same thing next week or not. I don't know what Gulf it's maybe. I hope that he doesn't stop at Mount McKinley and Gulf of Mexico. Let's rename everything. Let's name everything whatever we want. This is the time to do it. We're going to make these changes. We're going to make them now. Where he made he made there was like some kind of gender thing, and just like a lot.
Oh, he declared there were two genders.
There's two genders. He's declaring this. He's declaring that. Great, fine. I think that tariffs are the things that I'm thinking of that seem to be the most meaningful. Now, aside from like kind of foreign policy stuff, I don't really care that much about H-1Bs either way. Like unless it's like hugely, and also immigration. I'm not sure if things are going to be as dramatic as they were. I've been checking the news. I have not seen any troops on the ground in major cities.
Yeah,
and I think, call me crazy, I don't think it's going to be as dramatic as people. As people thought, or as was announced. I think people know that it's not going to be as dramatic.
What do you? I think you're right. It's some people want it to be dramatic because they've been living on the narrative that he is Hitler reincarnate, and he's going to start that day one. I mean,
or
he's the Project 2025,
he's the savior
whatever
of
it
all,
is.
or it's a savior of all.
It's literally savior or the devil, which it's never.
And so let's take this 25% tariff thing.
Yeah.
Or last I heard, before it was 25, it was 20. As far as I know, it was like a 20% universal tariff. And I did a little bit of reading, and I stumbled on an article. I just don't have it linked here, and I'll put it in the notes. It was by the Daily Economy article, and it used this interesting example of a tariff on Chinese tires. It's actually during the Obama administration. It was from 2009 to 2012. The tariff was 35%. The first year, then 30, then 25, whatever.
Did you see this video of him throwing pens into the crowd?
No.
He was signing executive orders, and he was like throwing it like a guitar pick.
Oh, wow.
Yeah.
And he was doing that during a party, during like a kind of, during the inauguration, like the event itself. It wasn't just like, let's step in the office and do the business.
He went to like the Capital One Arena and just started signing They had all these, like, I think Stephen Miller had like these executive orders, or somebody was like giving it to him.
Wait a second.
He was signing it, and he was like, sir, this will, take us out of the Paris climate
that's another
agreement again. And he would sign it, and he said pen, and then he started throwing the pens out.
So with that performance, is there any way maybe, now this could just be coincidence of words, that some of these executive orders are purely performative? I don't know. That's a little bit of a stretch, but
how dare you? Sorry to interrupt you.
Oh, okay, no. So just to put the tariffs into context, so there is, let's say it was a 35% tariff. Tire prices at max went up 21.7% in that period where there was the tariffs. Now that 21% or 21.7%, that means that the Chinese tire manufacturers, they ate a little bit of that cost, but still prices went up. 2/3 of it, like 62% of the increase, was paid for by the product price increase at the destination country. Yeah. So I think what this kind of illustrates is, yes, it's going to increase prices. I think personally tariffs are most effective when you're trying to prop up a product or protect an industry or something like that, not necessarily to pay the bills, but if you do the math, let's say you get that 35%. Let's say if we get 20% tariffs, that means that prices would increase by 12.4% of the tariffed goods.
Based on the tire example.
Now maybe that's not a good example, but like that's all I have to go with. And I like the tire example too because it's not 1-to-1. It doesn't mean you get a 35% tariff, you increase the price 35%, and they eat a little bit. Let's say they eat. Let's say they eat even less than 21%. Let's say they eat like 10%. That still means that if you do all the math, you give those 20% tariffs. For those goods that come into contact with those tariffs, that's 6% inflation. Add that to the 2.9 we have right now. We're right near where inflation was at its peak. That's why there's not going to be tariffs, because people did not like that. And like also we've described all these things that Trump did day one. He signed them in sharp. He threw that pen in the crowd. They had those ready. They had things buttoned up and ready to go. All of these orders. Why didn't I want tariffs? Let's say I want tariffs. I do want tariffs. Why didn't he have them? Why aren't they ready now? Why can't I have my tariffs?
It's a really good point. Why? Because they're all threats. They're negotiating. They're negotiating tactics now. But the challenges are, this conversation here is not in isolation. Other countries that are having the tariffs imposed upon them know that he's going to try. That he's looking for a deal. Mm-hmm. They want to get to a deal as quickly as possible. Yep. He has to make them think that he's serious and that there is some real action behind the words.
Yep, for sure.
And so I'm waiting for that, but I'm also waiting for the overreaction from that, because I think that'll be taken as like, oh, see, he is going to just do it. He doesn't know what he's talking about. He's going to increase inflation.
Well, because if people don't trust him, then he'll ratchet it up and get
Well, he'll
closer.
say, in his rhetoric will be that we're ratcheting it up and we're never going to let these things off, and to bring pressure on those countries to come to the table. And a lot of countries are, preemptively either getting ready to either counter the tariffs or they're getting ready to come to the table because they know that they're going to have to. Mm-hmm. And I think that what's interesting about all of this is this, like the second time around, is at first it was also novel. They were like, this kind of celebrity is president. Let's see what he does. And then the second time around, he has more of a mandate and has some momentum of where people have to say, we're going to have to actually listen to this guy and work with him. And I think that's foreign and domestic. I mean, you saw all of the tech CEOs. You're seeing Democrats that have never supported Trump now coming on behind him, being like, "Look, let's give this thing a little bit of a shot." And whether that's making a deal or working with them until he does something that offends some of them to where they can't work with them anymore. Although they've already done that and they've already come back around to working with them, but. He's got to have to set a hard line. I think, but countries do want to work with the United States, like Zelensky, Ukraine is, and Trump's, talked all kinds of negative stories about Ukraine, and I don't know about Zelensky individually, but Zelensky says he loves Trump and wants to work on a deal, because he's got to. Everyone is trying to get him on their side. They've realized that going after him and making fun of him doesn't get you anywhere. Yeah. So at least try to make him your friend.
That's what I think's changed.
Because he likes doing stuff with people he likes.
Yeah, that's what I think has changed, is that people have kind of, instead of not disgust but outright rejection, they're like, all right, well, how do I work with this? How do I negotiate? And I think it's and there's a history now. A lot of people used to be Trump's enemies. Now they're in his cabinet. Marco Rubio, he might be Secretary of
Yeah,
State.
little hand markup.
Yeah,
just maybe through some of the things that are, because we've got this Biz Now piece that we're just kind of showing the picture of President Trump now. But so government work, I mean, here, or remote work, I mean, government employees, I mean, that was one of the executive orders. They got to come back to the office now.
No, they're not.
No,
they're gonna stay home forever. That's a way to reduce the workforce, just like any good old company.
Well, but then he signed the executive order saying that everyone had to come back. And now you're saying that they're not going to come back, and so there's going to be natural attrition.
Yeah, I think the government. I do think it's a strategy to facilitate a reduction in workforce. One of their.
It's part of the Doge. I mean, this was the part of the idea.
Well, yeah, and I think maybe Elon Musk did that at Twitter just to help cut the workforce down. And there is another. One of the slurry of executive orders was about like, if you are an executive or in a leadership position in the government and you're not doing things right, we're going to come by, check on you, and you're out if you're not doing things right. So, it's sending him back to work.
How dare the government make sure its employees are doing their job.
I think
you don't have any right to tell them to do their job.
Well, this is what and that's what, he's throwing.
They've got a pension.
He's throwing the pens in the audience. This is what he's so that's what he's aiming to do. My realistic assumption is, what government in the history of government, this is not the first time people have wanted to reform government. This is not the first time in the history of government that people have talked about deregulating. It's easier
first populist movement that's ever happened.
Yeah, it's a lot of these are easier said than done, and a lot of these are probably going to be fought through the courts, or maybe we understand, oh wait, that regulation was there for a reason. That regulation was there for a reason. So this isn't.
But even that would be better, is to, again, you don't want to get rid of all the regulations, but if you they put a moratorium on a lot of the executive orders, were like no more until we can get a handle on this thing and figure out what's going on. Until we're like fully in control of like the seat of power.
And that's what I wonder too. Like, okay, they're getting rid of all these bosses. Is there a pool of talent that can replace all these people? Is the net benefit going to be
why are we replacing?
Well, I guess
needs to be replaced.
We'll just show them the door and then
using the Twitter example, I mean, everyone basically said that like Twitter is going to like not work and basically it's going to fail because you can't, like, these people all that had jobs were doing something important. And like I think like there were definitely some like interruptions and things were a little janky for a minute, but Twitter did effectively reduce its headcount, and it's Twitter. It's operating just fine. It's figured out how to operate.
It's a little different product. I think that may not be
social media company and a government. Like, what's the difference?
Yeah, but also like the people pulling out of Twitter and the valuation lost, and I also I think what you said before, private company and government and. There are things that make it.
There's bloat, and oftentimes you can't imagine a world without it, because it's like this is how it is, and there's all this emotional connection, or just legacy connection.
Oh, and I know,
reasons, but like how much of that is actually necessary?
Yeah, and a bureaucracy will grow to fit. It's like everyone, you give someone a job, they'll find work to fill that job, and so they'll say, So I totally agree. I just think that like I wouldn't get ahead of ourselves, because a lot of people want to bring reform. A lot of people want to cut the fat. A lot of people want things that are efficient, and I'm going to be curious to see what new tools they have, rather than just a line item list of stuff. Let's see some kind of methodology, or maybe a guiding principle that will guide what they're cutting, what they're not cutting. Like and if we want to start talking a little bit about regulations. Now, I don't think we may not have a specific article about this, but my opinion for regulations is like, well, there are some that are good, there may be some that are bad. Let's tie the regulations. Now, this is getting into our topic of the fires in Florida.
Los Angeles.
I'm sorry, yeah.
One of those places prone to natural disasters.
All right. Yes. The fires in Los Angeles is, you were talking about this before, there are a lot of regulations that maybe would prevent the rebuilding, that would make rebuilding slower. And I was saying like, well, could we not time the regulation, or have it be coupled with the, like, you can make this rule, but make sure that it doesn't take too long to enforce it. Let's make sure that there's not a backlog if you want to get your building permitted. Let's make sure that or if you want to get approval for something, make sure it doesn't all route through Ellen in accounting or whatever. Like, let's distribute the power, distribute the decision making, or just bring a bunch of bring a bunch of resources, money, whether it's money or people, to get the approval process sped up. Otherwise, maybe rethink the regulations themselves.
Well, I'm just really concerned for the people of Los Angeles and the Palisades and the whole affected area, because I think it's going to be a challenge. I think it's going to be a challenge to be able to rebuild and get approvals, or to do any repairs. I think that people are going to be, unfortunately, frustrated by the local and state governments.
Yeah.
And because they have no faith, all of this state, California in general, especially the cities, especially Los Angeles, they don't have any faith in markets. They're very highly skeptical of markets. They see business and markets as people who are trying to take advantage of others, like wholesale, full stop.
Yeah.
And so, but the reality is, capitalism, free market, it's all just about effectively allocating resources.
Yeah.
And the government doesn't know what resources that need to be allocated. There's too many decisions. There's too many homes. There's too many contractors. There's too many vendors. There's too many
placing
challenges.
a middleman, no matter if it's two or 200 people that have to approve your house, let me just build it.
And that middleman is not just like facilitating, but they're setting all these parameters of how individuals can transact with each other. And so they're putting limitations on what people can charge for things, because this whole idea of price gouging as a bad thing. And most people would say price gouging is bad, but they don't understand. It's because they don't believe in free markets, they don't believe in capitalism, or they're just ignorant of what prices are.
When it comes to like human lives and stuff, I feel a little bit different. Like I think it's a bad look to
it's a bad look
to picture the fire trucks, the private fire trucks, waiting outside a guy's house while his neighbor it's like burning down and threatening a larger pieces. Like there's a way where that doesn't make sense to me. I think that there are some.
Do you think private firefighters should be illegal?
No, I don't think it should be illegal, but I think that if you've got water in your fire truck and your neighborhood's burning down and your house is not, I think that this is like,
so priority should just like proximity to the truck. Like that someone has a contract with, like, okay, I'm in an area where I believe that the fire department, through regardless of the reasoning, I'm not confident that they're going to come to my house, and I therefore would like some assurance that there's going to be somebody to help put out the fire at my house. That creates some demand for an additional service, a premium service, just like there's private security. And so someone has a truck that has a water tank on it, and they'd say, hey, you know what? We already have the fire department, but you can hire me, put me on retainer, and I'll come to your house first. We have a deal. If in an emergency, just like you can have insurance, travel insurance. If you get injured, or if there's political or violence in a country, we're going to private jet you out of there.
No, I get it. I just think throughout history, private fire.
It mostly used to be private fire.
Yeah, it didn't. I just don't like. I just don't think it's a good look. I think that there are certain things where you probably could collectively deal with it.
I think fire, because there are collective. We're getting more political, but I think it's fine. Yeah, the fire department should be there to protect the community. I think collectively, people get together, let's chip in some money to protect the community from fire, because it can spread from house to house. Especially like a forest fire, we need some collective effort. And if anything, if we're going to spend so much money on the military or the National Guard, like this is affecting a lot more people and property.
And if you had a sprinkler system, you had a cistern under your house. You turn on the sprinkler system or whatever.
Yeah, I don't see how big of a difference. So I think people don't like the idea of.
I just don't like it's not a good look.
But like I just see like nothing wrong with it at all. But I was even speaking to something that is more controversial, and that's price gouging for essential items like water, like contractors. And the state is wanting to prevent contractors from charging above market rates for performing services in these affected areas. Now, the problem is there's not enough there's not enough contractors, there's not enough vendors. I
don't care. I agree with you there. Like when it comes to human lives, it's a little bit weird for me when I, to see things. But if it's like rebuilding and it's just like a price thing, it's like, well.
Yeah, I'm not saying that the police that the like Los Angeles Police Department or whoever or like the Los Angeles Fire Department prioritizes service based on your zip code and like your how much property taxes. Like again, if you're paying into the collective system of the government, like there should be no prioritization. Everyone should be treated equally, like under the law or the government. But you should also have the freedom to contract with other individuals and companies to receive services.
Now, here's something else. Now, I know this is a little bit different from what you were kind of discussing here about pricing and stuff. There is the story that I've heard, among the blue state people, is these capitalists are coming in. They're going to swoop in on the Palisades and they're going to buy everything for pennies on the dollar.
Yeah,
and that's like. So my home, but I don't have anyone else to sell it to, so I guess all right.
So there's two sides of the coin. Mm-hmm. So on the people who don't like the idea of that, the concern is someone's in a desperate situation, and someone approaches them and they're like, "I know you have a $4 million house, but look around, it looks pretty rough, and this is going to take forever. The process, like we're not even going to be able to begin to rebuild for years, maybe or a year, and you're paying a mortgage. I don't know." So I approach you and I say, I'll pay you 50%. It was worth $4 million. I'll pay you $2 million because I'm probably going to have to spend at least $2 million to get this thing built. I'm going to have to spend more money to clean it up and I don't know the time. It could take years. Now that family, they were thinking about leaving anyway. They've just lost their home. They have nothing that's attached to that area other than that's where they were living.
Yeah.
If someone's coming in with a lifeline. They have liabilities. They're paying a mortgage on a house that doesn't exist anymore. Why should the government get in between those two parties to say you can't make that transaction when that transaction could absolutely benefit the recipients?
Yeah.
Now, and no one's going to force anybody to sell something. No one should be forced to sell something that they don't want to sell, but they should be prevented from transacting on their property if it's going to be beneficial to them. And the government isn't the one who gets to decide how beneficial it is or not. And so the result is a frozen market, and you have homeowners, people who did take out mortgages, who are going to be put in horrible financial straits because they are stuck with a property that's probably going to be declining in value.
Yeah. Well, and that's circles back to kind of the title of this, and it's one of the issues that I was thinking about is insurance, and there was also stories of insurance. There was one insurance provider, I think it was in the Palisades, that a few months before the fires, they canceled 1,000 or more policies, and I think that that's also not a good look. And it also is like, okay, if you're recalculating, because they probably thought, oh wow, the math here is saying that fires are coming. Well, I think that they shouldn't be able to just cancel them. There should be a better way to either increase costs or the premiums or something. But that's not. And maybe now I'm moving into a way more regulatory or maybe a lot more rules, but I think that the way that this is going to get fought out is with, and the rebuilding process is going to naturally have to happen like the insurance level. The question of whether I want to build in the Palisades again is going to be dependent on, well, is insurance going to pay me if it burns down again? And is insurance going to be too expensive where I'm essentially buying a new house every year? That's what I was thinking too when we were talking about the Florida and the hurricanes. But that's where I think
it should be a sign that I think insurance companies should have some ability to decide that this is too risky of an area for us to insure. And obviously there's a state regulator that has to approve rates, and some insurers are saying you can't force us to enter into an unprofitable business.
If I know I'm getting sick, I can't say, if I just got cancer, I can't say, hey, insurance, I want to, and I didn't have insurance, I can't call up and say, hey, I get insurance. I think that it almost looks like the reverse is true now. Someone that knows more about insurance. But
at the same time, I guess I think there's the difference is, you had no real. If you had cancer, that's really no fault of your own. You didn't choose to have cancer. Now, if you did something like if you get injured doing something that is extremely dangerous that you're at fault for, your insurance provider may have some questions for you. I'd put it closer to that category of you don't have to live in the Palisades. You don't have to live in a fire-prone area. You don't have to live on the coast. But we would love to live on the coast, but it's too expensive.
and just to say that like, well, we're from here, we should be able to live next to the water. I should be able to live on the Pacific Coast Highway.
Yeah.
You should have to bear the full cost of the true cost of
yeah.
that,
And-
not the taxpayers.
And so I think that there should be a way to like ramp this up instead of either kicking someone off or there may be some wiggle room there. And what I was kind of getting at is like that negotiation, that kind of conversation is happening. It's happening in Florida. Maybe it's happening in Asheville, North Carolina. Post Hurricane Helene, and in LA where it's like this insurance is getting expensive. We don't want to and how's that going to affect cost of living? It's going to provide a backdrop for people to allow to rebuild, but you just have to figure out how expensive it's going to be to live there.
Yeah. I mean, I have family that live, my dad lives in the Florida Keys, and they know, very few people have insurance. I'd have like wind insurance. You may have some like liability insurance of somebody trips on your property, you're not going to get sued, but like no one can afford wind insurance. Now, some people do. Mm-hmm. It's crazy expensive, but pretty much everyone has to. It's hard to get a mortgage, so you pretty much are buying cash.
Okay.
And you're self-insuring, and you're just telling her.
If it happens, I pay for it.
It happens. I pay for it, and that's what most people do.
Yeah.
Now you have to be in a very like fortunate situation of where you can afford to do that. But if that's the real cost, that's the real cost, and maybe that cost is so high. People shouldn't live there.
Yeah.
Like you want to live on the side of a mountain. Well, that's great. It's great. You don't have a right.
Yeah.
Like you want to figure that out.
And that's
figure it
what
out.
I meant.
But we know
like,
you don't have a right to live.
Kind of
somewhere.
Yeah. What was kind of interesting is that outlook of how much risky it is changing. Whether it's you're a lot closer to the coast now in Florida than you might have used to have been, depending on how the waves have crashed or whatever. Where it's a little risky for hurricanes, maybe it's a little riskier for fires. And how do we how do you make sure that people are protected without without kicking them off insurance? Because I'm sure the math for all of these insurance things, how the risks are working out, is a lot different than it used to be. So we'll I do think it's easier to work this out through insurance than it is to try to fix it with government and regulation and guarantees and subsidies and aid and all this political stuff that may go away. That just doesn't seem as sustainable.
Well, and the government's so involved, it's not like that they can just take a complete backseat right away.
Yeah.
But I just see some of the things that are happening as just setting up for unintended consequences.
Well, and one of the articles said that they said maybe like $50 billion was the cost of these fires, and
I've heard estimates up to 150.
All right, I don't know what the figure that they said, and now this is just the proportion.
Keeps rising. Keeps rising.
Yeah, just the proportion of this. So that if $50 billion was the cost, let's say it's a neighborhood, not the city. I don't know. Then only $20 billion is going to be paid by insurance. The rest is up to FEMA, or FEMA's caps at like $46,000 a person.
And what they're building them to, it's like, do you have to build up to California's new, building standard? Like they have to have solar panels and all of that, and it compounds because on one hand you don't want to like make exceptions just because your home built down, now you don't have to build it up to code.
Some of these historic buildings,
you're never building it again, and that's just the unfortunate reality. And it's just it's unimaginable. Losing your home and your whole neighborhood and like your town basically just wiped off the face of the earth, burned down. It's truly horrible.
And I don't think it's their fault essentially for living there either.
No, it's not their fault.
Especially then, this is what I was kind of trying to get at. Neither maybe for Florida, for people that are living in Florida, things have changed very rapidly. And so, like, I don't know.
Someone's
I don't know
been
how
living
much
in Florida for decades, generations.
Yeah.
No, this is where they're from. This is where my family's from, and that's what's tough. Hopefully, cool heads will prevail, and
we'll see.
Everybody can rebuild. All right. Last, just real quick, and then I've got to run. I'm getting ready to be late for a meeting, man. We were going to do a shorter episode, and in terms of being a longer episode, but we're still working on a new acquisition of some apartments in southern Indiana. Did I say the market? Did I say the market last week?
No.
Well, still not going to find out the market. But we're still negotiating the PSA. Should be under contract this week. So get ready for an announcement from Gray Capital. You want to make sure you already have access to our portal to participate. You can find that at graycapitalllc.com. Click, sign.
register to be an investor on the portal, and schedule a meeting as soon as we launch the deal, which should be in the coming days. You'll get an alert, and off the races. All right. Thanks, everyone, for watching this episode. Catch you in the next episode of The Gray Report. Make sure you like and subscribe. Leave a comment.